Well, it's time for Chapter 10's lecture. Turn to your book to page 351, and there's quite a bit of information there about budgeting and the role of budgets and strategy, and the master budget is really the name of the chapter. We'll talk about some things involving the role of budgets and the management process, how strategy and budgets need to be tied together. A quick outline of the budgeting process, just a process that a company goes through to develop budgets. Then also how a master budget is prepared, and then talk about some of the relationships between the master budget and supporting schedules within it. Also, we'll deal with the uncertainty of the budgeting process, unique characteristics of budgeting for a service company. We'll talk about some alternatives, approaches to budgeting, zero-based, activity-based, and a few others. And then just some other behavioral considerations involving budgeting. So page 351 has some terminology on it. A budget is basically a plan of action. Okay, so it's both financial and non-financial. And it's not just expenses. Quite often, if you think of a personal budget, you might be thinking of, here's a plan for where my money's going. Okay, so you get your paycheck once or twice a month, and then you've got a plan for where does my money go. Okay, well, that's kind of what this is. A budget obviously has to include expenses for a business. What expenses do we have? Where does our money go? But it's also more than that. It's also a comprehensive plan of when does our revenue come in? When does cash come in? Will we have periods of the year where cash might be short? And if so, what's our plan of action to make sure we have enough cash on hand to pay our bills and stay liquid? And also doing a forecasted income statement, a forecasted balance sheet. Talk about purchases. Do we have enough money on hand to buy inventory? How much inventory should we buy? Things like that. And so that process of putting all this together is just the budgeting process that companies go through. So the strategy and the master budget, very important that the two are connected and linked together. And companies have to be very cognizant of the fact that strategies need to lead to specific budgeting items. And page 352 begins to discuss that. You need to start with a careful review of a company's organizational strategic objectives. Okay, and remember that when you talk strategy, you're typically thinking a long range out. 5 to 10 years is a very common strategy goal to have. So a company might get together and say, in 5 years, here's what we want to be. We want to be this size. We want to have this many locations. We want to have revenues of so many dollars, and so on. So it's our goals over the next 5 to 10 years, very long term. Okay, obviously, senior management of any business should be looking at this, and this should be a part of one of their primary responsibilities is determining what is the long-range goals of our business. Okay, and so within that, keep in mind that a budget typically only is about a one-year plan. I've done budgeting for a number of years, and I've done it for 2 different companies, and primarily we're just thinking of 1 year is the year we're kind of held accountable to. We do a 3-year projection, but 1 year is really the year that we're held accountable to. 3 years just because the numbers are there. So keep in mind then that every year the 1-year goals need to fit into the longer run goals, okay, the long-term goals. And then some long-term budgeting things to think about then are capital budgeting and the master budget. So when you think capital budgeting, and I want you to think about a company's plan to invest in or spend items on expensive items, okay? Capital assets, basically, a building, a vehicle, equipment, something that requires more money. Where's that money coming from? What are the alternatives? When should this item be purchased, and so on. Okay, so that's a capital budget. Obviously, those kinds of items need to be fit into a strategic budget. Okay, and the master budget itself then is basically an aggregation of all subunit budgets into a plan of action for a budget period. Okay, we're going to talk about different subunits of budgeting here very soon. Strategic budget expenditures then represent special class of capital budgeting proposals that lead to long-term value and a competitive advantage. So maybe it's investing in technology, maybe it's acquiring a competitor, maybe it's building locations that will give us an advantage over our competition. Whatever that is, a strategic budget expenditure represents capital spent to give the business some kind of advantage over its competition. So be aware of that terminology, pages 352 and 353. Okay, so the budgeting process itself, they walk us through many steps on page 354, and you can see there's a budget committee, a budget period, guidelines, negotiation, review and approval, and then revision. I have done budgeting from a couple different perspectives. When I used to be very involved in budgeting at Midland, I did that for a number of years, and of course there was a budget committee made up of mostly senior executive folks plus the departmental officer responsible for budgeting. And basically every year was when strategic management got to, or I should say top management got together, did their strategic planning. The next step was to communicate that to the budgeting committee, basically saying, here's what our long-term goals are, and here's how we see us being in a few years, and here are some of the strategic initiatives that need to be budgeted for this upcoming year. And of course, there's already strategic initiatives in the pipeline that are already there that continue to need to be in the budget and so on. Okay, so that was guidance received from executives about some budgeting parameters and so on. But the budget committee then is kind of overseeing some of those items. The budgeting period then basically is what length of time will the budget be set for? And typically at Midland, the budgeting process started in earnest in September. Some pre-work was done in August, but then really in September is really when it got going, with the goal of being done at the end of November. And then the budget is set for the next fiscal year, which is January through December. And that 1 year is what management is held accountable to, even though a 3-year budget was prepared. Budgeting guidelines is kind of the traditional budgeting process that we go through in terms of getting information out to departmental managers, communicating what the goals are, what items need to be budgeted for, a goal with maybe setting expenses at a certain increase and so on. Okay, so basically just the guidelines for this organizational year or for the next fiscal year. At USF, basically I have a budget. I'm a budget manager. The MBA program itself has a budget, and so I budget for revenue, which is basically the number of students we have, the number of credit hours to be taken this next fiscal year, and then the rate per credit hour. And that gives me my revenue budget. And then I have an expense budget. And my expense budget's primarily salaries. I don't include full-time salaries in that. I just had to include adjunct salaries because full-time salaries are on a different budget. So I don't have to worry about those. But any adjunct that I hire to teach an MBA class, I have to come up with a list of how many classes will be taught by adjunct, what the adjunct pay is, how many of those classes will be delivered this upcoming fiscal year, and put that in my budget. And then I just have some items for some miscellaneous things, supplies, printing, advertising, a few things like that. A lot of overhead type stuff I don't have to worry about. The university is holding that in a separate budget code. So for me, what I control then is revenues and expenses. That's what I'm budgeting for that I can control. Okay, anything that I can't control is not put into my budget. And a different budget code is used for those types of items that administration themselves take care of. So when the budgeting process started for us, and actually it's not even done yet because our fiscal year is July 1, We started it back in February. I remember working on it around President's Day, and the VP of Finance for the university just sends out um, this huge Excel template with a lot of instructions on it. And some of those instructions include kind of what the goals of the budget are for the year. And she's reporting to a subcommittee from the Board of Trustees who oversee the finances of the university. And before any information set out by the VP of Finance, she has had meetings with this Board of Trustees subcommittee about what the budget process should be, what the goal is for revenues and expenses, and so on for the year. I know where they have the most trouble budgeting is with the traditional undergrad classes and guessing, literally almost guessing, I think, how many undergrad students will be coming in as freshmen for a particular year. I think that is typically one of the um, more challenging things to do. In the MBA program, we've had a very steady head count. It really hasn't grown, it hasn't shrunk. The numbers have been very steady, so it's easy for me to budget that. But so there's those guidelines that are sent out, and then there's a negotiation, review, and approval process, and that's what's been going on lately. Um, my budget really has not been a part of that because it's really not a difficult budget to come up with. But I know many other departments across the university are going through that. I know that athletics, there's always challenges there in athletics in terms of budgeting scholarships, travel, things like that. So that process is going on right now. Every now and then I get some emails kind of keeping the university up to date on what the process is. And I heard yesterday that the goal is that the budget will be approved very soon. So just keep in mind there is a process you go through, and I would imagine many of you have been involved with budgeting already also. So now some businesses will review their budgets during the year. I have never been a part of that. Basically at Midland, once the budget is set and approved, it doesn't change for the year. I have heard that USF, though, will change a budget during the year as information may change or so on. So different ways to look at it from that perspective. And so the master budget, and the master budget then is your basically your grand plan of action. Okay, it's a guideline, and it should only be completed after there's been many rounds of meetings, negotiations, give and take, going back and forth, communications, and basically, ultimately, we're trying to translate short-term objectives, what's going to happen this next year, into specific action steps. And then basically saying, if these things happen the way we think they will, you'll come up with what they call a pro forma set of financial statements. Pro forma, I like to think of it as if. Okay, so whenever you hear the word pro forma, think as if. These are what our financial statements would look like as if the actual numbers turned into this budget projection for the year. Okay, this is what our financial statements would look like based on all of our projections coming up for the next year. Okay, communicates to employees and managers expectations of top management. That's a key one also. But it's also incumbent on top management to make sure that communication happens regularly, is clear, it makes sense, and people know what's expected of them. Okay, and it helps coordinate activities. Okay, so that's the goal of the master budget. Quite a bit of information on page 356 worth looking at. Okay, operating budgets then for a master budget. Plans to identify resources needed to carry out budgeted activities, okay, like sales and services or production. Okay, so think of the operations of a business. What drives revenues? What are the things that need to be done for our business to happen, to sell our services, to sell our products to our customers, and make sure they're getting what they need on time? That's an operational budget. Sales and services, making sure those activities are being taken care of, and what are the costs surrounding those. A financial budget identifies sources and uses of funds for budgeted operations. Where will the money come from? So a budgeted statement of cash flows, a cash budget, a balance sheet, capital expenditure budgets are key into a financial budget. So a financial budget is broken down into these subcategories here. Basically, where is our money coming from and where is our money going, and will we have the resources we need to fulfill our budgeting requirements for the year. If we're going to go out and acquire another business, build a building, buy some equipment, invest in software or technology, will we have the cash? Where is it coming from? How much will it cost? When will it be spent? Things like that. To prepare an individual budget, such as the sales budget, as you see here, they call it a three-step process. Okay, and they talk about sales budgets on 357. Define the bottom line information contained in the budget. Okay, what are sales for the upcoming year? Determine what this information is a function of. Okay, budgeted unit sales times budgeted selling price would obviously give me my revenue for the year. How many units will I sell, and what do I expect to sell each one of them for? And then put together information in a user-friendly way that makes sense, that people can look at and understand. Okay, that's what they mean by doing a specific individual budget. Now, on page 357, they show you Exhibit 10.2, and I want to make sure you look at that and just see how these different budgets fit into the master budget. It's kind of a good flow chart to see how everything makes sense. You can see financial budgets on the bottom. In the middle are the operating budgets that deal with the cost of running our business. And then at the top is the capital budgeting, basically the big ticket items that we're going to buy for the upcoming year, and that will support future years also. A sales budget then has two components, basically the volume of sales for the year and then what the price is for each unit that we sell. Each unit could be a physical thing, or it could be a service that our company is providing. And they show us a picture of a sales budget right here. Also the same information is on the top of page 358 in Exhibit 10.3. Okay, so we budget number of units. We also budget the sales price per unit to get to sales. Okay, typically this is one of the first sub budgets done as a part of the master budgeting process, because a lot of other things will rely on what we expect to sell. So if I'm going to sell 20,000 units, I obviously need to have 20,000 units on hand to be able to sell them. And so the next step is, how do I get those 20,000 units? What will they cost me? Or if I'm manufacturing them, how much will it cost to make them? When do I have to spend the cash to acquire them, and so on? Okay, but sales is one of the first things you look at. This is just a budget for a quarter, just April, May, June. So it's basically budgeting to sell $2.4 million worth of units for this quarter into June 30. So once I've got my sales in place, then I go into my production budgets. Okay, so I have to make sure, especially for manufacturing, that's where the most complicated one is. I have to make sure that I have enough units on hand to sell them. Okay, if I don't have enough units on hand, I can't sell them. Okay, I'll never meet my budgeted sales because I don't have enough to sell. So I got to make sure that I make enough units. Okay, and so I'm going to have to come up with a production budget. I need to have enough units on hand to sell, plus I should have a cushion, right? I need to have a few units on hand so that I have, in case my sales are more than what I think they'll be. Okay, so what I need to produce is enough to meet my sales goal, plus a desired ending inventory, which is my cushion. But of course I can subtract what I already have on hand. Ideally, I have some units already on hand when the quarter begins. Okay, so that's how I figure out how much I need to produce. That's right in the middle of page 358. Okay, so here's an example. Beginning inventory is 5,000 units. A desired ending number is to have 30% of the following month's projected unit sales. Okay, this is as of April 30th. We're saying in May we expect to sell 25,000 units. Okay, so I need to have on hand 30% of that 25,000, which is 7,500. Okay, that's my cushion. I expect to sell 20,000 units. My goal is to have 30% of the next month's sales on hand. Okay, and I already have 5,000 units made. Okay, so that means I need to produce 22,500 units. And of course, this cushion, this 7,500, allows us that if sales go crazy, we sell more than 20,000, that we've got units on hand to be able to sell them, and hopefully we don't run out. Okay. Of course, if sales are poor, we've made too many, and there's a cost to holding too much inventory. Okay. And so we turn that into what they call a production budget, and they show us one in the middle of page 359. Okay. And we build in assumptions. These are great things to do in Excel. And once we have our budgeted sales for the year and a desired ending inventory, which with some Excel formulas we can set as 30% of the next month's sales very easily, these things will just kind of spit out the numbers and give us a budgeted production number, so that then we know how many units we need to produce or acquire to be able to meet our sales and have a cushion left over. Okay. So once I know how many units I need to manufacture, okay, so basically 22,500, 28,000, 36,500, I'm now saying I need to produce 87,000 units for the quarter. Okay, so now that I know that, the next step is to say, okay, I need to have a direct materials budget. Okay, I need to have direct materials usage budget and a direct materials purchases budget. Okay, because if I'm going to make units, I have to make sure I have all the raw materials that I need on hand in time to be able to support production. Okay, so Exhibit 10.5 is on page 360, and be sure to read about some of the information right above it. Direct materials budget and direct materials purchase budget is just right there, a paragraph right above Exhibit 10.5 on page 360. Shows the amount and budgeted cost of direct materials required. Last line of production budget equals the first line of the direct materials usage budget. Okay, so when we go back here and I say I've got 22,500, 28,000, 36,500, and 87,000 of units to manufacture, those numbers are the first line of my direct materials usage budget. Okay. To continue that thought, contains budgeted purchases in units and dollars of direct materials needed for the upcoming budgeted period. Okay, in this example, we're using a quarter. Okay, it's needed to complete the direct materials usage budget. Okay, basically, which will help us understand how much money will need to be spent on acquiring inventory. Is a function of materials required for production, targeted ending inventory materials number, and then how much raw materials already on hand. Okay, and of course what the cost is of those things also. So here's an example then of the direct materials purchases budget, which is Exhibit 10.6 on the top of page 361. And then this is showing us, based on the information on the bottom of page 360, is then used to complete this. Okay, so it's telling us the direct materials needed in production. It's telling us the desired ending inventory numbers of raw materials. Okay, obviously we want to have a cushion of raw materials on hand, just in case we need to ramp up production. We want to make sure we have everything we need on hand. Of course, we have a desired ending number on hand also, and that gives me then a number for how much materials I need to purchase. I'm estimating a cost per pound or a cost per unit, whatever that is. This is basically telling me how much money I expect to spend on direct materials for the next 3 months, for this quarter of the year. And of course, that's important to know. I need to make sure I have enough cash on hand to be able to buy those items. Okay. Next is direct labor. Obviously, if we're going to be manufacturing something, I need to have the raw material on hand. I need to figure out how much I need and what the cost will be. And then I have to make sure I have enough labor on hand, enough people who are trained and skilled in making whatever it is that I make. Okay, so potentially I've got skilled labor and semi-skilled labor. It's important to separate those because one's going to get paid more than another. And this labor budget is a function of how much we expect to produce from the production budget, then how much we expect to pay our employees, labor hours to produce something, and then the rate per hour. Most companies will have a budget for time it takes to produce something, and then how much somebody will be paid per hour to produce something. Okay, and so you can see here that for every unit of production, we expect to use a half an hour of semi-skilled labor and 0.2 hours of skilled labor, each having a different rate per hour, which makes sense. Okay, and so they talk about the labor budget on page 362, and they show a direct labor budget on the top of page 363, which is exactly what you see on your screen here. Okay, so we're going back to our production, which came from a previous budget, and we're saying for semi-skilled labor, it's a half an hour per unit. So that gives me then the number of hours and the rate per hour, and then a cost for semi-skilled labor. And then when I look at the skilled labor, again, I go to my production budget, how many units I'm going to produce. I multiply that by the fact that for skilled labor, I'm using 0.2 hours. I get the total amount of hours needed for skilled labor, the rate per hour, and the cost. Add the two together, rows 5 and 10, and there is my labor cost for the next 3 months. Okay, cost of goods manufactured and cost of goods sold. Cost of goods sold budget is prepared after the overhead budget, and Exhibit 10.8 is the overhead budget in your book. It's on the bottom of page 363. And quite often what companies will do is they will tie into direct labor hours is a very easy number to track, right? When I've got direct labor, people are punching in, punching out, coding their time to the manufacturing of a product. So direct labor is always an easy number to get a hold of. And so a lot of companies, what they do then is they'll tie in their factory overhead into a rate per hour based on direct labor. And what you see on page 363 for the factory overhead budget, you see the variable factory overhead, which is tied into production and how many labor hours are being used or incurred during the quarter. And you get a rate per direct labor hour. It says rate per DLH. That's direct labor hour. And we come up with supplies, indirect labor, fringe benefits, power, and maintenance, all as rates per direct labor hour. And we use that to compute variable overhead. So that variable overhead only happens or is directly affected by how many units we produce. And then we have fixed factory overhead, which has nothing to do with how many units are produced. That factory overhead is the same no matter what. You can see the categories there of depreciation, insurance, taxes, supervision, power, and maintenance. So we take overhead, we split it between variable and fixed based on the cost and how it behaves. Okay, but then we add them all up and we get a total factory overhead budget, and then we figure out how much cash will be needed to be spent on overhead also for each of the 3 months that we're budgeting for. This is Exhibit 10.9, which is on the top of page 364, and this is my cost of goods manufactured and my cost of goods sold budget. And they just gave us 1 month here, the month of April, but in the book you'll see April, May, and June. And notice that they're bringing in information from other budgets at this point. We're bringing in direct materials, direct labor, and overhead, adding them all up for the month of April, and saying my total cost to manufacture in the month of April will be 422,625, and then I have my finished goods beginning inventory, okay, which is just a given number to us. We're saying we had on hand when April began 90,000 worth of goods already manufactured, okay, and so potentially to sell to our customers, we have the 90,000 of goods already made that was there when April 1 happened. We made 422,625 worth of goods during the month of April. So in total, we have available to sell to our customers 512,625 worth of goods. Okay, but we subtract that then what's left over at the end of April. We had a finished goods inventory of 140,875. So that means cost of goods sold then is the difference, which is 371,750. And that's a number that goes directly to the income statement. So that's an important number to budget for. But notice that when we get to this point, we're using inputs that came from previous budgets. Okay. Next is selling and administrative expenses. Okay, so everything we were budgeting for so far really dealt with sales and the manufacturing, production, cost of production of making whatever it is we make in our factory. Okay. Next then is the selling and selling and administrative expenses. Okay. That's everything else. Okay. Expenses that are expensed as incurred, and the cost of sales, of salaries for salespeople, commissions, distribution, advertising. Think of managers, executives, the accounting staff, the HR staff, people whose jobs are needed to run the company, but these people have nothing to do with the manufacturing of the product. Okay, and so basically expenses for everything else, and they're basically expensed as incurred is the way to think about it. Obviously, that's where you have a lot of discretionary expenses. Whenever a company is hurting and trying to cut back, you always think of discretionary travel. Are there certain things we can cut from travel? Do we need to go to every single training that we're going to do, or seminars or conventions and so on? So that's where, if there's a budget cut, typically this is where you look. Okay. So here's an example then of a cash receipts budget involving operating activities. And what they don't show you in the PowerPoint, but you should look at in the book then, there's a selling and administrative expense budget on the top of page 365. And that's a good one to take a look at real quick before we move on here, because they're showing us expenses organized by 3 different months of this quarter that we're looking at. And they split this into selling expenses. Some selling expenses are variable because they're based completely on sales having to happen before those expenses are incurred. So a sales commission, delivery expense of delivering our units to our customers, bad debt expense, basically what happens when we sell on credit and customers don't pay us back. Next is fixed selling expenses. We have some sales salaries that are fixed. I would imagine the way it works with many companies is salespeople have a fixed salary, then they get a commission above that. Advertising, so obviously if we've committed to signing contracts to pay for advertising and we've got a fixed budget for that, some advertising can be variable, but a lot of it would be fixed. Some delivery expenses would be fixed. Depreciation typically is viewed as a fixed expense, and so then we add variable and fixed to get to a total selling expense. And then we have administrative expenses, which is basically everything else. Administrative salaries, so that would be salaries for your accounting, HR, executives. They have an accounting and data processing line. They have a depreciation line, other administrative expenses, supplies, things like that, to get to a total number. Then they subtract the total selling and general and administrative expenses. They subtract from that anything that's non-cash to get to a cash number, so the company knows how much cash will be needed to actually pay for those items in the next 3 months. Okay, so what you have on the screen then is Exhibit 10.1, and that's beginning our cash receipts budget. They start to describe that on the bottom of page 365. Then they show you the cash budget itself here on page 366, and they show us a partial on the screen, March and April, but then in the book they show us, of course, March plus every other month. The reason they show us March is you need some of that information to move on to April, May, and June. You need some of the information from the previous month to move on to the next month. Most businesses are selling on both for cash immediately and for credit. Okay, so you can see that they've taken revenues and split in between two categories: cash and bank credit card sales. So those, of course, are automatic, right? If a customer pays me cash, I've been paid. If a customer uses a credit card, I'm going to get paid because, of course, we swipe the credit card and it's instantly approved or not approved, and the sale happens. So those are sales that we know we're going to get paid for. Okay. After that, then we make credit sales. So we're granting credit to a customer, and we're basically believing the customer will pay us some date in the future. And so the reason it's important to split cash from credit sales is we're trying to figure out a cash receipts budget. So I need to know when I make a sale, how much of that is going to be cash I'm receiving now versus cash received next month or some other time in the future. Okay. So we have to come up with assumptions based on that. And in this example, when it comes to cash received from cash sales, we're saying 60% of cash plus bank credit card sales. Okay. And when it comes to bank credit card sales, we're not going to receive dollar for dollar. The credit card company keeps a piece of it. So we're saying we're going to receive 97% of credit card sales. Okay. So when we make a credit card sale, we get 97 cents on the dollar because the credit card company is keeping the other 3 cents as their fee. Okay. So that's part of that budget, and then we've got the accounts receivable budget. Okay. And the way it typically works is we assume we're going to receive so much of that now and so much of it later. Okay. So the reason to do April's cash receipts budget, I have to look back at what were the credit sales the previous month to be able to assume that a portion of those will be collected in April. Okay, and so from credit sales the month before this month, I have to look at that prior month's credit sales, and then after the cash discount period, how much will be received. So if we're offering a discount, let's say a 2% discount or a 3% discount, if the customer pays me within 10 days or something like that, many customers will take advantage of that and pay me sooner rather than later. Some will pay me just later though. And so those are the assumptions I'm building into this to come up with how much cash will be received in the month of April. But I have to know what prior month's credit sales were to come up with how much of that will be received in cash this month. So that's what a cash receipts budget will help us compute and figure out on page 366. Obviously, once we have some assumptions, it's very easy to program those assumptions into an Excel spreadsheet and use that to help us come up with this budget. Next is a cash budget. They begin to describe a cash budget, basically the middle of 366. They show us one on page 367. And so this brings together the cash effects of all the budgeted activities. So the bottom line of many of these different budgets we've been looking at has been showing us how much cash will be needed to support this. How much cash will be needed to buy inventory, to buy raw materials. How much cash is needed to manufacture our product. How much cash is needed for labor. How much cash is needed for selling and administrative expenses. How much cash will then be received as we sell our units to our customers, and when will that cash be received. Okay. Now know that a cash flow statement, which is one of our financial statements, and our financial statements are the income statement, the balance sheet, and the cash flow statement, is when it comes to cash flows, we organize them into three categories. Cash flows from operations, cash flows from investing activities, and cash flows from financing activities. Okay, and that's what they're showing us in the cash budget that you see on page 367. Okay, preparation of this budget involves careful review of all other budgets, right, to know where's the cash coming from and where is the cash going and what is the timing of that. Okay, so here is then a partial look at the cash flow from the cash budget on the bottom of page 367. This is the April column that you'll see in Exhibit 10.12. It says 10.14 on the screen, but it's actually 10.12 on page 367. And notice that we start out with a cash number from beginning. Okay, we're saying that when April happens, we expect to have $75,000 of cash on hand on April 1st. And then we have our cash flow from operations. And notice that we're tying in other budgets that we've done. The cash receipts budget, which is actually Exhibit 10.11. And so that number, that 539,664, came from the bottom of page 366, the April column. We expect that we're going to receive cash in the amount of 539,664 in the month of April. And then our cash is going to go out the door as we buy raw materials, direct materials, as we incur labor, as we incur overhead, and as we incur selling and administrative expenses. These exhibit numbers I don't think are all correct, but these are the ones we've covered in the previous pages. The direct labor budget, I should go back a spot here. The direct materials budget was on page 360. The materials usage budget is on 361. The labor budget and overhead budgets are both on 363. The selling administrative budget is on page 365. And then the cash receipts budget is on page 366, which all ties then into the cash budget on 367. Okay, so operations, cash flow from operations. We're looking at a manufacturing company. A manufacturing company makes things and then sells them, right? They're buying raw materials. We're adding labor and overhead to turn that raw material into a finished good. And then we sell our finished good to our customers. Some of those sales are for cash, some of those sales are on credit, and then we're budgeting when we expect to receive the cash for those sales. All that gives me cash flow from operations. We want that to be a positive number, right? We want our business to generate cash by doing what it does, okay? That's a key number. This is a positive number. It's not huge by any means, but it's at least it's a positive number. Investing activities is cash spent on investing back into the business, okay? This one example is zero, but if we were to buy equipment, it's basically the purchase of long-term assets is really what investing is. It's money we plow back into the business to maintain and grow the business, okay? So as we buy typically long-term assets, those are investments in our business, okay? Next is financing activities. Financing activities come from bank borrowings, okay? So that would be a cash flow in if we borrowed money from a bank. As we repay that, that'd be a cash flow out for paying principal and interest. If this was a publicly traded company that had stock, if we sold shares of stock, that'd be a cash flow of financing in. If we purchased treasury stock, that means basically the company's buying its stock off the market, that'd be financing activity, cash flow out, and so on. Paying dividends would be a financing activity with the cash flow going out. Okay, so typically most businesses, you want to see a pattern with your cash flows. You want to see your cash flows from operations as being positive. Typically most businesses, your cash flow from investing is negative because you're taking your cash from operations, you're taking a portion of it and reinvesting that back into your business. The cash flow from financing could be either positive or negative, and it's really just a matter of what's been going on with this company. If it's been borrowing money, that'll be positive. If we've been repaying it back, it'd be negative. Budgeted income statement and balance sheet. We really haven't talked much in the class about these financial statements a whole lot. But there's an example then of an income statement in your book. It's on page 368. And I want you to be aware that the income statement shows us revenues less all expenses to get down to net income. Okay, revenues are in, positives, expenses are out, negatives, and revenues minus expenses equals net income. Okay, and so what companies like to do is budget an income statement to say, if our sales forecasts come true and all of expenses the way we think they're going to happen play out the way we think they will, it'll turn into an income statement that looks just like this. Okay, and you can see one on the bottom of page 368, and I'll show it to you here soon. Same with the balance sheet. A balance sheet shows a company how many assets it has, how many liabilities it has, and what owner's equity is. And it's called a balance sheet because it needs to balance. Assets has to equal liabilities plus equity. Okay, that's the key. An asset is an economic resource that a business uses to help it earn revenues. Okay, that's what a balance sheet is. And a liability then is somebody's claim to those assets. Okay, so if I have a loan payable, the bank has a claim to the assets of my business. Equity then is the owner's claim to the assets of the business. So it's money that the owner has either put into the business, or it's the accumulation of earnings that the business has kept. Okay, so that's just a quick synopsis of a balance sheet. They show us one on page 369. So here's an example of an income statement. You can see revenues here, and then they're taking gross revenues, subtracting potential sales discounts, subtracting service charges that the bank credit cards will charge us to get down to net sales. From net sales, we subtract cost of goods sold, which came from one of the budgets that we did, which gives me my gross profit. My gross profit then contributes to or pays for all of my selling and administrative expenses. Once those are paid, I've got operating income of $46,914. And then I subtract interest expense and taxes to get down to net income, which is $32,840. Okay, here's my balance sheet, just the assets. Okay, think of cash, receivables, inventories, property, plant, and equipment. Those are typical assets. An asset just is anything that a business owns or acquires to benefit the business in the future. Economic resources. Liabilities then are outsiders' claims to those assets. Accounts payable, bank loan payables, income taxes payables are all prime examples. Equity then is the owner's claim to the assets of the business. So accumulated retained earnings, and then common stock is money generated through the selling of stock to stockholders. Okay, the final parts of the chapter deal with some specific examples of budgeting in terms of doing what I'll call the what-if analysis or sensitivity analysis. And what's nice about budgeting is I've always used Excel as a budgeting tool, and the great part about that is you can use it to say, okay, if sales increase by 10%, what will my financial statements look like? If they decrease by 10%, what will they look like? If we raise our sales price of a unit by $5, what will our financial statements look like? If our labor goes up, what will our financial statements look like? It's that sensitivity analysis or what-if analysis that we can do, which really is great. Sometimes companies come up with 3 budgets for a year. They'll talk about a best-case budget, a worst-case budget, and a most likely budget in between. They actually produce all 3 and compare their actual to all 3 of these budgets. I think manufacturing companies tend to do that. For service companies, budgeting is a little bit different than a manufacturer, obviously, because we're not making a physical thing. Okay? Instead, we're delivering a service to a customer, so we have some different considerations to think about. Um, they talk about service companies and budgeting, um, starting on the bottom of page 373, top of 374. And so for a service company, because it's typically people delivering the service, and a couple of prime examples I can think of would be a law firm or an accounting firm, people is your biggest expense. Okay, it really deals with personnel. Do we have enough staff on hand? And do we have enough staff with the right skills on hand? Okay, that's part of the budgeting process for a service company. So I just want you to read through some of that information. That's what they talk to you about on 374. Beginning on 375, we look at some alternatives to budgeting. Basically, most companies budget based on what I'll call an incremental budgeting. And whenever I say incremental, think of change. Okay, incremental equals change. And any company that I've ever done budgeting with, now keep in mind I primarily work for service companies, either financial services or education, okay, is you look at what's been done in the past, you take that as a foundation, as a basis to jump on to for next year. So you basically take your base budget or what's happened this past actual year and you say what will change next year. Are we going to grow? Are we going to shrink? Are we going to take on some new initiatives that will change our budgeting? So basically incremental budgeting is taking what you've been doing and changing it as needed. Okay, that's one way to do it, probably the most traditional way to do it. But there's other ways to do it also. Zero-based budgeting is becoming more popular. And basically with zero-based budgeting, you start every year at zero. You don't look at what's been done in the past. You don't look at what's been budgeted for in the past. You basically say, every year we have to re-justify everything. Okay? We start every year with zero expenses, zero revenues, and every revenue and every expense has to be justified. Obviously, the revenue side is the same. I mean, basically, we're going to project sales, volume of sales, rate per unit, and get a sales number. On the expense side, though, we're going to have to justify everything. Okay? Every activity, every function, we're going to go through and say, does this make sense? Does it need to be here? And so on. Okay? So while it makes you really think through and reevaluate how things are done and look at your business from a new perspective, those are good things. The problem is that it's very time consuming. Okay? And maybe a company stretched for resources just doesn't have the time to go back and do zero-based budgeting. Okay? But it's an alternative. It can be done. Another alternative is activity-based budgeting. So again, when it comes to activity-based costing, we're looking at drivers. What drives costs? What activities in our business make costs occur? Okay, so once we've identified that in a cost accounting system, the next logical step is to budget for those items. So it's really an extension of activity-based costing. So a company that uses ABC costing will use ABB, activity-based budgeting, and come up with a budget for all these activities, and then how many of these activities will happen, what the budget should be for these activities, and so on. Okay, and then the time-driven activity-based budget is just a subset of that also. Next is Kaizen budgeting, and that's becoming a little bit more popular. I've heard more about that lately, the past few years. Kaizen budgeting is on page 378, and it talks about continuous improvement. Okay, that every budget process should have some kind of improvement in it. Okay, so we need to be more efficient in how things are done. If it's our deliveries, if we're going to try to use fewer vehicles to make deliveries to save some time and money on the operation of our trucks, maybe that's part of that process. If it's coming up with better manufacturing processes that will save us time and money, is we're going to come up with improvements in the budget and use those to make us better. Behavioral issues in budgeting. Budgetary slack, padding the budget, and that's always been a concern for all budget managers. Or when I was kind of in charge of accumulating budgets and gathering budgets from people, it was always, um, how much padding is there in these budgets? Are we guessing revenues too low so that we can easily jump over that number and look like the hero for having more revenue than we budgeted for? Or with expenses, kind of the same thing. Is it there that attitude of, if I don't budget for it, I'll never get it, or if I don't spend it, I'll never get it again and I'll lose it? What kind of attitude is there in the business when it comes to a budget department and budget managers? And that's where communication is critical, and management and the budget committee having clear and concise communications with budget managers, having regular meetings to say, here's our expectations. Just because you don't budget for something doesn't mean you necessarily can't spend it this next year, or if you don't budget for it, you lose it forever kind of mentality that can exist with some businesses. So just be aware of that one. It talked to us a lot about these items on page 379 and 380. Goal congruence basically just means, is everybody on the same page, yes or no? And obviously top management needs to communicate that, right? Top management, a budget committee, all those things need to be what their desires and goals are, need to be communicated on downward to other employees in the business, so that all budgeting can happen based on everybody knowing what the goals are and how their department or their unit of the company fits into that, and budget accordingly. Requires a lot of communication and planning, right? But that's an important thing to do to make sure everybody's on the same page and we're all heading towards the same goals and budgeting for them correctly. Okay. Some businesses will try to come up with a audacious budget or the big hairy goal budget. Try to do a stretch budget. I've heard different words for it, and try to get people out of their comfort zone and say, let's have high goals, but also make them be achievable, because a budget should be motivating. And if a budget is viewed as, there's no way I'm ever going to achieve it, it's not motivating anymore. So there's behavioral issues around budgeting that we're talking about here. Linkage of compensation to performance. If the company outperforms its budgeting, will there be extra compensation? Some things like that. Just, I'd be curious. We'll talk about in class a little bit about, does anybody have any experience with anything like that? So kind of different businesses do things like that different ways. So we'll talk about that in class. So that'll wrap it up. Hopefully it made sense. Obviously, bring your questions to class and we'll talk about it some more.